In this video, we are going to talk about efficient diversification. For the calculations related to this chapter, you will want to watch the video with the Excel spreadsheet that deals with the capital allocation line. And that's where we work through the numbers. Here, we're going to talk about the concepts and understanding some of these graphs and what they mean and how to interpret them. Okay, so some vocabulary: market risk, systematic risk, and non-diversifiable risk all mean the same thing. There's just three ways to say the same thing. Risk that cannot be diversified. They call it market risk because everybody in the market is subject to this risk. Nobody can get away from it. Now, how the market risk impacts different firms could be a little slightly different on how much they absorb of that. But everybody has market risk. It's part of the system. So that's why they say risk factors common to whole economy. Then we have what we call unique risk or firm-specific risk, or non-systematic risk, and also known as diversifiable risk. Once again, all these also mean the same: unique, firm-specific, non-systematic, diversifiable risk. Now, this is just risk that can be eliminated by diversification. We'll talk about that some more in a moment. But to give a quick example of a firm-specific risk, let's say UPS and Federal Express, FedEx. UPS their employees are in a union, so they have a union for UPS employees. FedEx does not. So that will be considered a firm-specific risk of UPS that FedEx doesn't. And it doesn't have to be firms within the same industry. For example, any company in the medical field is going to share that firm-specific risk of liability towards patients patients. While a car company does not have that. A car company may have its own unique risks, but the point is that each industry or companies may have firm-specific risks. Okay, so this is a graph, so we can start to understand this diversifiable risk or firm-specific versus market risk. Let's look at the one here on the right first. So what we're saying is that if you start combining stocks from different companies, you can reduce the unique risk, the firm-specific risk, the diversifiable risk, as you see here. So the x-axis is number of stocks. So as you increase the number of stocks, and you want to have stocks from different industries, as you keep on throwing in more stocks in your portfolio, you can start bringing down the standard deviation on the diversifiable risk portion. Market risk, as we explained, everybody is subject to that. So you can't really get rid of this. This is just the nature of the economy. And that's why you see that if you have one stock, just one, you taking the entire risk that comes with it. But as you start adding stocks to your portfolio from different industries and companies, it will start bringing down that standard deviation. But you can never really break below the market risk line. That's as far as you can go. The more stocks you have, the closer and closer you get to the line, but you will not get below it. This here is just this piece here by itself, the top part. That's all they're saying, that you can add stocks and bring down the diversifiable risk. So this line, I guess you can say, is the same as this dashed line here. And that's what this is trying to represent. Now, how we combine those stocks, it has to do with correlation, covariance, variance, standard deviation, beta, all these things. So the way it's done is through technical analysis, meaning you will use historical data and assume that it will pretty much continue the same pattern in the future. Now it's going to change, but as you see here, it changes slowly over time. So you're not going to be perfect, but you should be close enough. And what you do is you adjust as time comes in, and new information and data is available. You keep on updating your calculations. That's what we call rebalancing the portfolios to be able to get that relationship that we're looking for between the stocks for your portfolio. Now, like I said, it's technical analysis, and as long as there are no surprises, it's fair to say that the pattern up to this point could continue. Now, when we say historical, you don't want to go too far in the past. The most recent activity will be a better predictor of the coming up activity. However, I always have to mention fundamental analysis, meaning that if there's a fundamental change in one of the companies or the industry, then you're going to have probably then a big change very fast that you'll have to adjust immediately. But as long as there's no surprises, like we say, as long as there are no surprises, you should be able to count on this for your portfolios. So if the focus for risk on deviations of returns from average value, that's where the focus is. That's really the key to understand how you're going to combine these stocks in your portfolio. So let's start looking at some graphs and charts. Okay, for right now, ignore most of these. Let's just look at this one straight red line here. Let's just look at that one so we can talk about it. So let's say we are dealing here with two stocks. We're going to say stock A is down here and stock B is up here. So if you put all your money in stock A, you'll be at this point, which is about, let's say, what, 7% standard deviation, and let's say about 4.5 returns, right? Roughly speaking, it doesn't matter. So if you put all your money in stock A, that is the risk you're taking, 7% standard deviation, and you're going to expect about 4.5% returns. If you decide to put 100% of your money in stock B, you're going to be here. That's roughly 10% returns for 19% standard deviation, somewhere in there. So let's say there's two choices, all your money in B or all your money in A. However, you could put half and half, right? So if I move to the half of the line, that means that 50% is in stock A and the other 50% is B, and that'll put you right in the middle of the line. That will be your new standard deviation, and it's just a weighted average in this case. So you can do any combination of percentages. Yes, say you put 90% in stock A and 10% in stock B. That means you move up the line about 1/10. You can do 25% stock A. So let's put it on here. I'm sorry, 75% stock A and about 25% stock B. So you're going to be mostly towards this side. And you go 50-50, and then you keep on going. If you're to do 90% stock B and 10% A, you'll be somewhere here. You get the message. Okay, so when you have a straight line situation, that means that those two stocks have a correlation of 1, positive 1. That's this one here. Correlation of 1, you get that straight line. And all it means that you trade off as you move money from one stock to another, you're trading your position in the line. Now let's ignore all these now. Let's look at this real sharp one here that touches here. So same situation, let's say stock A and stock B. So if you put all your money in stock A, you will be here. If you put all your money in stock B, you would be here with those returns. Now, this line, however, in this scenario, we're saying that they have a correlation of -1. Let me go and elaborate on this correlation business. So when I said earlier correlation 1, that means that when stock A is moving up, stock B is also moving up. So they both move in the same direction at the same time. That's what correlation +1 is. Correlation -1 means that when one is going up, let's say stock A is going up, then stock B is going down, and vice versa. When stock B is going up, stock A is going down. So when you have that perfect opposite direction, now you have a -1. And when you have a -1, this is what happens when you combine them. If you have 100% of stock A, fine, you're here. If you have 100% of stock B, you're here. But because they have a correlation -1, that when the one goes up and the other one goes down and vice versa, what happens if I do 90% stock A and 10% stock B, I'm going to start moving around this line. If I do 80% stock A and 20% stock B, I'll move some more. And these are my new positions. So I'll go 50-50, I'm going to be here. If I start putting more than 50% in stock B, I'm going to start moving this way in the line. Then as I go 50, 60, 70, 80, 90, until you hit 100 in stock B. And that's what happens at correlation -1. Depending what percentage you combine them, they're going to be on this line. To be on this line, you got to have more than 50% in stock B. To be in this line, you have to be more than 50% in stock A. Okay, so what happens when you're not -1 and you're not 1? You see these straight lines? What happens if you're in between those two? Which is just about everything. It's rare to ever come across a -1 or +1. And if you ever come across it, it doesn't last. It changes. So really, everything else is between less, is a higher than -1 or less than +1. So here are a couple examples of correlation to 0 and 0.2, which are two values that are in between these two values of -1 and 1. So let's talk about 0.2. 0.2 will be this light gray one that has curve here. So the explanation is the same. As you change percentages, you're going to move up and down that curve. It's just that when you're not a -1 and you're not a +1, everything else in between is going to have some kind of curve shape. If you go down to 0 correlation, we're looking at this red one here. It just moved a little more to the left. And the idea is that if +1 was here, the straight line, if I go down to 0.2, I'm going to find myself moving to the left. If I go further down to 0.0, I'm moving more to the left. And if I go all the way to -1, I'm all the way to the left. However, like I said, everything is always less than 1 or greater than -1. So you're always going to see some kind of shape curved, some kind of curve shape like this in a portfolio. All right, let's talk about those curve shapes. So here, as I mentioned, regardless of what kind of combination you have, you're going to end up with a curve shape like this. And it might shift around and move around the graph, but is the same. If you notice, I'm going to put another one here. Similar curve, different slopes, sure, but similar curve shape. So no matter which example you look at, you're always going to have some kind of shape like that. So let's go back here. To identify a few things, this is an example of if you have bonds versus stocks. So if you go 100% stock on your portfolio, yeah, you're going to have high returns, but you're also going to have a high standard deviation. All right. Then as you add bonds, because it helps on your risk to lower your risk, but it's also going to lower your returns. Now, this minimum variance portfolio, what they're talking about is that no matter how you combine these stocks and bonds, that's the lowest standard deviation you're ever going to achieve. You can do all kinds of combinations, infinite amount. But the standard deviation with this set of stock and bonds would not go below that number in this case. And every portfolio will that is a combination will have that somewhere. And the shape is always the same, so it's the leftmost point. Okay. And then what happens if you go too heavy on bonds and almost no stocks, the standard deviation starts turning on you. But that's an explanation for a different section. All right. Now let's look at this so we can talk about the trade-off of standard deviation and returns when it comes to portfolios. Okay, so on this line is we call the efficient frontier, and these are the portfolios we've been talking about so far. Now these portfolios have a bunch of stocks in them. These dots in here represent the individual stocks if you had them individually instead of combined in a portfolio. This is where they would be. By the way, Everything on the line is efficient. Everything under the line, we're going to call it inefficient. And I'll explain that a little more why. And anything above the line is called unattainable. That will be the best you can do with this set of assets, getting on this line. We're going to talk later in a minute how you can use the risk-free asset to get above the line, but without a risk-free asset involved, this is your limitation. That's what's called frontier. You can get past that. Now, here's the deal. This is why portfolio is more efficient. Let's say we have this stock here, right? It doesn't matter. Some standard deviation, some kind of level of returns. This stock here that I'm pointing out, let's look at that. What this is saying is that if I combine these in a certain way, I can achieve one or two things. I can go ahead and for the same standard deviation that that stock is in, that same point, there's a portfolio that has a higher return. So why would you invest in a stock that has this level of risk with this level of return when there's a portfolio that has the same risk, but a much higher return? So that's how we say that you can achieve a higher return for the same level of risk. Another way to view it is if we go left instead of up. If you have a stock with this level of returns and this level of risk, there's a portfolio that can give you the same level of returns, but a much lower risk. So no matter how you look at it, it is better to have the portfolio than to go with this individual stock. And it always will work that way. You can always get a higher return for the same risk or same return for a lower risk. Either one is an improvement. And you can do that same thing with each one of those. Each one of them, there's a portfolio that beats them in returns for the same risk or beats them in risk for the same returns. And that's why this is efficient and individual assets are not efficient. Now, let's talk about if we have a risk-free asset like a treasury bill, which we do in this country, in the United States. So what happens is that without getting into the calculations, like I said, that's part of the Excel sheet video for the capital allocation line. When you go ahead and combine these portfolios with a portion of T-bills or any bond that is a risk-free, now you can create this line, which is called the capital allocation line. So bringing in a risk-free rate security allows you to now reach outside the efficient frontier, which we had earlier called unattainable. Now you can. There's a series of calculations, but you can combine portfolios. And not only you can reach outside the efficient frontier, but every portfolio here is the optimal, meets the standard of the optimal portfolio from this curve. That's what we call the Sharpe ratio. So you don't have to sacrifice efficiency moving up and down this line. Well, here you had to. And in a nutshell, then once you have a capital allocation line, the point is you just choose. Yes, as risk goes up, you can get higher returns. So that's normal. The point is that your efficiency is the same here to here. Unlike when you're in the curve, let's use one more pronounced. When you're in this curve, as you try to get more returns, you see how it starts to flatten out. You become a little less efficient than the one down here because you're starting to take more risk than the returns you're gaining. Here, you don't have that problem. It's a straight line. So if you want more returns, just take the same amount of higher risk. And that's it. That's it for this video. Please watch the Excel sheet version related to this video with a capital allocation line.